Welcome back to Inside Out. Well, let's get straight to our Swotlight segment. And the stock we're focusing on today is Mayur Uniquoters. That's the largest player in the Indian synthetic leather market and one of the largest players globally as well. They are involved in the manufacturing of polyvinyl chloride synthetic, and over the next few years will be looking to ramp up its polyurethane revenues as well. Synthetic leather, well, it finds preference in comparison to natural leather as it's more environment friendly and also finds higher acceptance among ethical-oriented customers, which include vegans as well. Additionally, it provides substantial cost arbitrage in comparison to natural leather. Their products find its application in automotive, footwear, as well as furniture industries, and their client list includes both domestic as well as international automakers and also various footwear makers. Well, hence the company is touted as a proxy play to the rising discretionary spends towards fast-moving consumer items. Now, their revenues are mostly from the domestic market, with exports contributing around 30% of revenues, and bulk of the export revenues comes in from auto OEMs. On the domestic front, the auto revenues is accounted for via OEM and replacement sales, while the footwear segment contributes close to around 25% of their business. In the last few years, the street has been waiting for growth to ramp up, and the management's guidance has been a little bit sketchy. But now they are indicating they're in for a good phase of growth over the next 2 years, with the auto export growth expected at a faster clip. They have indicated ramping up revenue from big international automakers like Mercedes, BMW, and they've also added Ford Motors to their list of clients. The domestic auto segment as well is expected to see double-digit growth, while the footwear segment, it's been reeling under some pressure, but the management is optimistic about mid-single-digit growth. Overall, by 2025, revenue should surpass around 1,000 crores, and they have margin levers in place as well. That could include ramp-up of the margin-accretive exports, benefit of operating leverage, and lower PVC prices. Additionally, they have a clean balance sheet with cash of around 170 crores and also returned part of it to shareholders via regular dividend payouts, and have also done a couple of buybacks in the last 3 years. Now, valuation-wise, the stock trades at around 20 times trailing EPS, but factoring in the management can achieve that 1,000 crore revenue target, then it's relatively more attractive on a forward earnings basis. Moving to the shareholding pattern then, its promoter entity holds roughly around 59% stake in the company, and around 9% is held by some large funds. Now, risk, there are a few. They include what if the global slowdown derails their growth plans, which in turn will impact profitability as exports are the driving factor out there. And also we understand that all is well between the promoter father-son duo, but in case re-emergence of friction between them, that could be an overhang for its shareholders as well. The India PU market, well, that's currently dominated by Chinese imports and presents a big opportunity. But as of now, revenues from that segment have clocked just around 25 crores. That's a far cry away from its capacity. Well, we've run out of time on this edition of Inside Out. It's goodbye from Sonal and myself. But you do write to us and tell us about companies you want us to discuss, and we'll try to feature some of them on our show. Thanks so much for watching.